You've been taking advantage of volatility in the market.
Right.
How have you done that, and do you expect to continue to be able to do that?
We expect to be able to do that for a long time. The macro volatility provided by the Fed, by politics, by trade issues, oftentimes is a short-term issue for a lot of these companies that we're focused on. Looking out 2-3 years, focusing on the true cash flow of the companies, the stock prices are far more volatile than the cash flows. So last year, input cost inflation, trade issues with steel, all led to industrials being pressured, margins getting squeezed. We use that to buy those stocks. We're seeing some other things today that's similar to that.
So what are some of those other things, and where are they leading you, if not just back to some of the names you mentioned?
Yeah, so we're, again, focusing back on the industrials. Then we're also finding value in some of the insurance names. The financial sector can move around quickly as yield curves invert, rates move around, and tied to that, we're finding unique ways to play the housing theme. Fidelity National Financial is a good example of that, ticker FNF. That stock is currently going through a merger with Stewart, and that deal I think will close. When it does, it's very accretive for the stock, and it's not priced in right now. But the stock is moving around due to some volatility in the financial sector.
I want to bring in Hodges Small Cap Fund Manager Eric Marshall as well. Eric, give me your take right now on sort of where things stand, given overall a strong market so far as we kind of get ready to close out the first quarter with the S&P up over 12%.
Well, we've certainly had a good quarter coming off of the December lows. I think the market in the December timeframe really priced in an economic slowdown that we haven't really started to see materialize. And we think right now, although investors are very concerned about the yield curve and trade and a lot of macro things, we're really laser focused on what's going on with the domestic small cap earnings of the companies that we own in our portfolios, and we see them actually holding up relatively well. We think this is the time to really be focusing on earnings, and we still think investors can find good risk reward in this market.
You know, on the yield curve, Bryant, that everybody's talking about, the consensus from a lot of the interviews we've had on CNBC from investors and strategists and economists is pay attention, but you don't have to worry about it just yet. Is that the right advice?
I tend to agree with that right now. I think the Fed's going to wait till they see the whites of the eyes of the enemy to do any moves from here. I would say I'd look for a prolonged, weekly, monthly even, inversion before I start to worry about the economy. But I do think it has an impact on stocks. For example, banks will be drastically impacted by the movement of the level of rates and the curve itself. Again, that tips money from banks into insurance, for example, within financial. So I think we need to worry about it and focus on it, but we probably have some time till it's a true signal for us.
Eric, it's funny, both you and Bryant seem to be focused on value stocks as opposed to growth. And, of course, there are many value investors who keep waiting and waiting and waiting for when it's going to outperform growth. Why? Why even bother?
Well, I think all the trend in passive investing has really rewarded momentum investing over the last 5 years. And I think that the incremental value fundamental buyer out there, there's fewer of us out there. So when the market does have these pullbacks, to Brian's point, the volatility becomes more extreme. And I think in this environment, you can really take advantage of that. So, you know, we're looking for periods of volatility to step in and pick up things at good prices at a time when there's not very many people doing that.
Yeah, I mean, it's interesting, of course, the changing nature and complexion of the market structure itself, Eric, as you say, has, well, it's changed dramatically even over the last 5 years. We're only going to see more of that, right? Passive investing seems to still be the way so many dollars are flowing. Does it change your approach at all, given that?
Well, I think at some point you run into a tipping point. Now, over half of the new money that's coming into the market is being invested through passive investing, through ETFs and index funds. So I think once you get to that tipping point where the majority of the money is already being investing that way, that momentum slows down. And I think when that happens, that's when value really gets rewarded.
How about you?
Because at the end of the day, good capital allocation really matters across these companies.
I fully agree with Eric on that. I think passive investing has pushed the market into momentum-based trades, and the most tracked index for passive investing is S&P 500. The sector tilts of that index are in technology, discretionary, healthcare, the growthier side of our universe. And so as money flows into there for reasons other than fundamentals, possibly, it drives growth stocks. The same will be true on the other side of that. When that flows out, we saw it in Q4, when markets go down, pull people money from the passive investments, they're pulling from this tech, discretionary, healthcare. Value will beat growth, in my opinion, when that happens.
Has it been frustrating, this period, for you? I mean, in terms of, obviously you guys are both running portfolios. You're also trying to attract assets. It's not the easiest time to do that.
I would agree with that. It's not the easiest time, but we're successful doing that still. I think we need to recognize what is our time horizon versus what the market's time horizon is. One of the best advantages we have as active managers is time arbitrage. The market can do things for very short-term reasons, and if you have a 2 to 3 year view of things, you can take advantage of that, and we've done that successfully. So time arbitrage is our edge against passive.
You just got to make sure your investors are in there with you.
You need the right investors, which I'm glad we do have.
Eric, any specific catalyst coming up, either macro or micro, that'll cause this shift and this rotation that you guys are hoping for?
Well, we think like right now, with interest rates coming back down, there's some interesting opportunities out there. Obviously, we think with the bonds doing what they've done here in the first quarter, they're no longer attractive, and we should start to see companies that are able to generate reasonable earnings growth at decent valuations start to outperform. So we like things like home builders right now, materials. We also like certain areas of technology, such as the semiconductors, and some of the consumer discretionary names, which you really have to look at on a case-by-case and really put a lot of emphasis on stock selection.